Good day to all our viewers and listeners. Welcome back to another exciting episode of our podcast series at Exness with my co-host Sihle Tuta, our commercial director for South Africa, and myself, Terence Hove, senior financial market strategist at Exness. And we hope today's topic is going to be an intriguing one because I think everyone is always wondering, what is a trading strategy? How do I create one? What goes into the formulation and how do I benefit from it? So tune in and listen in to the conversation. And remember to follow our social media pages, subscribe, like, and comment. And if you've got questions as well, maybe you can pop them there. We can always pick up on some of those questions and incorporate them in the following episodes. And maybe you've got a different viewpoint. It's always good to hear what comments you have. So please do like, subscribe, and comment on our socials. Sihle, how are you doing, mate?
I'm good on yourself, Terence.
I'm very well, thanks. And today we're talking about trading strategies, how to create one, what goes into one. What is a trading strategy?
So starting from the premise that trading is a business, right? Or at least we should treat it as such, right? All businesses that take themselves seriously have a business plan, right? They have a business strategy, which is basically a map or a roadmap that is going to guide them towards their goals, right? To where they want to get. So basically, a trading strategy spells out a lot of things. What instruments you're going to trade, when you're going to trade, what type of risk you're going to assume, your trading style, and things like that. It's basically your how of trading, right? Now, a very well-known commentator in the trading circles, Simon Brown, he has a thing where he says a trading strategy should basically be a set of rules that you follow, right? Things that you look out for or boxes that you must tick before you take a trade. So he has, I think, between 7 and 8 rules that he follows before he takes a trade.
Right.
And he says successful trading is about following your rules to the T. Right? So if you have these 7 rules or 7 boxes you want to tick before you take a trade, if one box is unticked, then you should not take the trade. So he says in the beginning of your trading career, you should not focus on trying to make money, or you should not focus on the cash.
Right.
You should just rather focus on perfecting your trading strategy. You should focus on following your trading rules every time, all the time. And once you are able to do that consistently, the money will come. Right. And I agree with him because a trading strategy is basically about your ability to follow your rules strictly. Because your rules basically make up your strategy. Right? How much you're risking on a trade, what instruments you're trading, when are you entering, when are you exiting, and obviously your risk management. So these becomes your rules, which then form your strategy. And then your job is just to follow these rules every single time without getting your emotions involved. In fact, a trading strategy basically saves you from making all the wrong choices because it's rules that you follow. So that's basically what a trading strategy is.
And you make a point of what goes into it, you know, the rules, what instruments to trade, and the size of the, of the trade, the lot size. And so when we speak of trading strategy, Sihle, we're looking at, for example, some traders would say they want to make $500 a day. Now, can you formulate a strategy that does that, i.e., and in doing so, do you work backwards to say, so I need $500 a day, I need to do this, that becomes the plan? Or do you formulate a strategy that makes you 500 today, 1,000 tomorrow, 100 today? I mean, what then goes into it?
So firstly, Terence, I don't think you can be in a position where you know how much a strategy is going to make you on a daily basis. Right? Otherwise, and a lot of people will be, millionaires and billionaires. So it's almost impossible to know how much a strategy is going to pay you. Right? And I also don't think it's wise to have monetary daily targets to say, I want to make so much money in a day, because you don't know what the market is going to give you, and you can't predict with absolute certainty how the market is going to move in pips and in terms of volume, which then determines obviously how much you make.
Right.
Rather, I think it's actually wiser to approach this from a risk management point of view to say, how much money am I willing to risk on this trade? Manage the risk part first, and then let the profits take care of themselves.
Right.
Because the most important thing in trading, or at least in my opinion, is the preservation of capital instead of profit generation. Right? You should look after what you have first before you try and chase profits. So if you manage your risk first and put your stop losses in place, and then just take what the market gives you, because we all know that in this business, the more you risk, the more you stand to lose. And the more you lose, the more difficult and the longer it takes to recover what you've lost before making a profit. So in actual fact, we are more risk managers than profit takers. So if you approach this from a risk management point of view, you'll be in this business for a very long time. So I tend to stay away from the mentality of says, I want to make $500 a day, or I want to make so much money a month, because sometimes the market moves in the range for a week, which means there's no major movements. What happens then? In 1 month, you may make even more than you expect. Right? But it has to be within your risk management parameters. You need to take what the market gives you. Because when you have specific targets, especially if they're monetary, you can end up becoming frustrated, because what happens when the market goes in the range and it doesn't give you the number of pips that you want? Then you're going to begin to overtrade. You're going to begin to double up because you're under pressure to hit your monetary target.
That monetary target.
Exactly.
Yeah. So when you say it that way, this then means trading is very much on, as you mentioned, number one, risk management. So that becomes the first thing to include in your trading strategy.
And in fact, it could be the most important. Right. And I'll make you another example. I remember some years ago, my mentor at the time, so he shares a story of how one of his students in the UK came to him very excited because the student had doubled their money in less than a week, and it was their first week of trading. So you can imagine the excitement when the student came to him. And then he said, I said to him, oh, wow, you've doubled your money in less than a week, and it's your first week of trading. And he said, you must be doing something wrong. And the student was amazed. I mean, how am I doing something wrong when I've doubled my money and it's my first week of trading? And the mentor said, if you have doubled your money in less than a week and it's your first week of trading, it means you would have made that amount of money quickly, or you would have lost it all, because your performance has nothing to do with your trading skills. It was purely based on luck. It means you were risking too much in relative to your account size. I mean, if you have 100,000 and you make 200,000, your balance after a week, it means you're over trading. It means you're taking positions that are way too much for your account size. Either that was going to happen, or you were going to lose everything in that same week. So the student obviously took heed to the advice and really realized that, okay, I was just on the lucky side of the trade. It's not because I was skillful. It basically means, he did something wrong. Another example that I like to make, Terence, when I chat to traders, I mean, to simplify this example, we all know, right, that a trip to Durban from Johannesburg or from any city to the other, in this case from Johannesburg to Durban, takes about 6 hours, right? If you're driving within the speed limit, which is 120 kilometers an hour. So 120 kilometers an hour, you are in Durban in 6 hours.
In 6
right?
hours, yeah.
But if you come to me that you left Johannesburg at 12 o'clock and you are now in Durban at 3 o'clock, which means you took 12, 1, which means you took 3 hours. You come to me, you expect me to clap hands for you. Yes, you reach your destination in half the time, but it means you're overspeeding. It probably means you are not stopping at robots. It probably means police were stopping you and you were not stopping. You know what I mean? So you were doing something wrong. Yes, it does not mean that you should be commended for for your efficiency. I mean, a 6 hour trip, you did it in 3 hours. That's good, but it means you're doing something wrong. Same thing applies to trading.
Right. That's a very good analogy, and which then asks the question, in trading, do you become more skillful or do you become more lucky with your trading strategy? So that trading strategy, you've done it, you've perfected it, you follow it to the T. The consistent results you then get after that, do these speak to skill or luck?
I think a bit of both.
Okay.
The more you trade,
Right.
the more screen time, the more charts you study, the longer you trade, the more skillful you become, and the luckier you get. Like, the whole saying, the more prepared you are, the luckier you become.
Right.
So I think it's a bit of both. But I have to emphasize the input or the importance of risk management in your trading arsenal, because the money you lose is difficult to recover, right? Because when you lose money in the markets, before chasing your profit, you've got to recover what you've lost, which means it's almost like double the effort, but there's nothing you can do on your side to earn it back quicker. So the risk management part is very critical. Now, you have to look at this in numbers terms or probability terms to say, my trading strategy, what is the probability of winning against losing? Or what is my winning rate? So out of all 10 trades that I take, how many am I likely to win? Let's take an example of somebody with a win ratio of, winning 3 trades and losing 7. Because that's what your trading strategy needs to determine. Out of average 10 trades you take, how many are you likely to win and how many are you likely to lose? Which is then going to speak to your risk to reward ratio.
And people focus so much on that risk reward ratio. Is it an important thing? See?
It's very important, Terence.
Yeah.
And I'll tell you why. So let's say you have a trading strategy, because I really want to make this as realistic as possible. Right. Let's say you take 10 trades a week, but you only win 3. Which means your win ratio is 30%, which I think is achievable for even beginner traders.
Right.
That means then your reward for the 3 trades that you win needs to be high, as opposed to when you win 7 trades and lose 3. Now, if you have a reward of 3%, so let's say you're risking 1% on a trade and you're targeting 3%, you want to do this on 3 trades. You can lose the other 7, but you're winning the 3. So 3, 6, 9, right? That's 9%. And if you're risking 1% on a trade and you lose 7, how much have you lost?
Yeah, quite a bit.
You know what I mean?
Yeah.
So you've lost 7 trades and 1%, 70%. You're winning 3 at 3%. It's 90%. Then you subtract the 70% of the losses from the 90. You're still left with 20. Which is your profits. So you can lose more than you win in terms of number of trades. But because you've got a very healthy risk to reward ratio, you can still be on the upside. Because a lot of traders tend to think that I have to win most of my trades. That's not the case.
Not all of them.
No. And think about it. I mean, how bad of a trader must you be to lose 7 out of 10? Yes, we know it happens, which is why I'm making this example.
Right.
So this example is on the basis of you being that bad trader. So out of all, let's say even 100 trades, you lose 70 and you only win 30. But if your risk-reward ratio is healthy, you can still make a profit. It just comes down to discipline.
So this is an interesting question I'm going to ask you, Zeke. Right. Firstly, the question is, what is losing?
Okay.
Right? So you've mentioned 3 wins and 7 losses. And what I mean by that question, being in the industry with you as you are, what is actually a loss? So you can have an open trade that is in the red.
But it's still open.
But it's still open. But it's not necessarily a loss. Right? Which opens another can of worms altogether. And then there's the account that is stopped out, which popularly known as it's a blown account.
Okay.
Right? because that stop out is forced, right?
Yeah.
It's not a choice that
So
you
predetermined, yeah.
Yeah, so which means it's a blown account, nothing, it doesn't exist.
Okay.
And then there's the taking your actual loss.
Okay.
You know, so, look, yeah, I'm in the red. So what actually is losing? When do we call it losing?
So, again, risk
And
management.
I'll give you this example.
Yeah,
Sorry.
okay.
I'll give you this example.
Yeah.
Some many moons ago, I had a client, very good trader, and female as well. This also shows that good traders are both male and female.
Yeah.
And she kept layering her buys, but she was buying in losses because the market was moving against her. She bought all the way to 1600. The market stopped at 1609. Call it there. She bought all the way there, 1609, right? And we are having this conversation in a space of a year, year to date. And if we look at the price of gold, maybe a few months out. But this example means that if we say a year to date, that means this time last year, she was in the red, right? X amount.
Yeah.
Because she kept buying into losses.
Yeah.
But those buying into losses, right, today were phenomenal buy levels.
Yeah.
That would probably, give her the name an oracle of trading,
Yeah.
right? Had she held on for the market to turn. Hence, I then ask, what then is actually a losing? Or when you say you've lost 7,
Okay.
yeah, an absolute number.
So remember, we are coming from the premise that every trade you take must have a target
Right,
in terms of profit,
right,
and it needs to have a limit in
Right.
terms of your risk appetite,
Right.
a stop loss.
right.
Ideally, you should have a stop loss and a target price, take profit. And some traders do trade without a stop loss, and you really have to know what you're doing if you're trading without a stop,
stop
loss.
loss, yeah.
Okay. Now, a loss is when a trade reaches your stop loss, right? And you're out with a loss, so
Yeah.
it's money taken out of your
The
your
position is closed.
position is closed with a loss. It hits a stop loss.
Yeah.
So there is a loss.
Yeah.
Now, there are cases, like I say, of traders who trade without a stop loss,
Right.
who take a position, let's say a buy, and it goes against them. It goes the opposite direction. But because there's enough equity in the account, the trader can hold the position for a while.
Yes.
And
That's
now the challenge is,
Yes.
how long is a piece of string?
Yes.
You don't know
When?
how deep in the red that position is going to go, right? I mean, what if it goes against you for the next month or two, if you're a swing trader? Do you have enough equity to sustain that position?
Yeah, right.
You know what I mean?
Yes.
We can't maybe call it a loss because the position is still open.
Yeah.
Anything can still happen, and it can go in the right direction towards your profit level. But do you want to do that to yourself? Do you want to be in a position for a month when you don't know which direction it's going to take? Because the very fact that it went against your trade, it means that you made a wrong judgment. So do you want now to be 60, 80% in drawdown on the position? I mean, that's unhealthy. That's no longer trading, that's gambling, right? So what is a loss? For me, a loss is when a trade has went against you, it's hit a stop loss, and you're out of a position. You've taken a loss. However, back to our example of a healthy risk to reward ratio, you can take 7 losing trades in a row, and then the last 3 to hit the 10, hit your profit target, and you're up. So have you lost?
No.
Overall, you haven't.
Yeah.
Now, the lesson here is that losses as we know them are part of the business. They are trading expenses or cost of doing business, right? You made 100,000 for the month. Your cost of doing business was 70,000, right? And you made the 30. The losses could have been one after each other, which can be very discouraging. But in the bigger scheme of things, for the month, for the quarter, you were still up.
Interesting. So So this begs the question of advice that I was once given some many years ago around trading.
Yeah.
In particular Forex trading, and that you need deep pockets to trade foreign currency or commodities like we have. Because think about it, Sitley. I mean, at 1609, gold at 1609, and this is another peculiar thing as well in terms of traders who trade gold. Most of them take long positions. They never trade it the other way in terms of shorting gold. So hence, they miss that trade that the market is moving lower, right? And it is improving your average, but in a loss as compared in a profit. So another way to look at it, would it then be wrong to say, change your trading strategy according to your market conditions, to say, right now, it's a selling market. Sell. And once that selling is done, it'll show you when to start buying. The buy at that level is not wrong, but it's not the right time for it yet.
Yes. So remember, this is all speculation, right? You do your research.
Right.
You peruse your data. At the end of the day, you're speculating because there is no one, there is no machine, there is no bot who can predict the market with absolute certainty. You can have all the right tools in your arsenal and still be wrong, right? Meaning, again, risk management is key. I note your point about the person who said to you, to succeed in this industry, you need to have deep pockets. I will tend to disagree. I would say in order to be a successful trader, you need to observe the rules of risk management. You need to take positions which are relative or suitable to your account size. You cannot be trading full standard lots on a $500 account. You are gambling, right? Which is why some traders use a table to say from an account equity of this amount to this amount, this is the appropriate lot size. Yes, we have to factor in your trading style. If you're going to be a swing trader, your risk management is different to somebody who's a scalper. You know what I mean? So these are all things, again, that have to be factored into your trading strategy. How much capital do you have? What is your trading style? How much risk are you assuming? What instruments are you trading? Are you a swing trader, position trader, scalper? All these things have to factor into your trading strategy, which is why you need to give yourself time and not be in a hurry to get rich overnight, which speaks to about something we spoke about in the previous episode, the misconceptions and myths about trading. Don't try to get rich quick. Try and hone your skill. Try to master your strategy, and then the money bit will take care of itself. Again, Terence, remember, I want to sort of remind our viewers and our listeners, we're not giving advice here.
We're not giving advice.
We're just talking about trade ideas. Anything can happen. Trading is risky. You can make a lot of money. You can also lose a lot of money.
So this is, again, still speaking to the trading strategy, but a different face, to the picture. So you are the trader, and you've perfected your trading strategy. And then this speaks to another question. Maybe we can then cover that at our next, podcast, which is then what then becomes investing and trading. Because on my part, I can then give you $10,000.
Okay.
In my books, I'm investing in the business of Sihle Tuta, who enterprises in trading activities, speculating, whatever. It's all speculation, right? And then as an investor, I then get, my capital back plus money on top and so forth. So then when you've perfected your trading strategy, do you remain a trader? Are you now an investor? Are you now a portfolio manager? I mean...
So there's what we call gambling, right? Which is people do at the casino.
Right.
The blackjack, poker, whatever. Yes, we've heard of cases of gamblers who who win more against the house. So we know there's a thing called the house always wins,
Yes.
which is the case in gambling. But some gamblers have an upper hand because of their skill and because of their experience. Okay, but you're not talking about gambling here. Trading versus investing, the fundamental differences. Investing takes more long term. And that's what we see with investors who buy stocks in the stock market. They buy and hold for 2, 3, 4, 5, up to 10 years. It's more long term. You expect to reap returns or you expect ROI in the long term. Trading is more short term. It can be within the hour. You expect returns or losses within the hour, in 4 hours, within the day, within the week, within the month. It's more intraday, which is why we've got scalpers, we've got position traders, and all these type of traders. So trading is more intraday as opposed to investing, which is more long term. Right? Trading is riskier than investing because as much as you can lose money as an investor, but your returns tend to be small and consistent, and the risk is not as high as compared to trading. So trading, people tend to lose and make a lot of money.
Okay.
Whereas in investing, people are likely to make money in the long term. Yes, there are temporary dips in market prices, but in the long term, people tend to make money. And the differences with trading and investing, the type of returns that investors make in investing tend to be lower than what traders make in trading, although the risk is much higher with trading. As an example, we hear of some portfolios in investing earning, 11, 12, 15% per annum. Whereas we hear of traders who have mastered their skill, although it's not guaranteed, who make those returns monthly and quarterly. But we must emphasize the element of risk.
Well, Sihle, on that point, emphasize the element of risk to our viewers and listeners. We hope you found this episode very informative. And I think we'll have quite a lot of questions that will come, from this episode, and probably will lead to follow-on episodes as well to this topic. So please comment, and we are reading those comments. Follow us on all our socials, Instagram, Facebook, Telegram. Don't forget to subscribe and like and leave that comment. And thank you for tuning in. Until next time, it's bye from myself, Terence Hove, and my colleague and co-host, Sihle.
Cheers for now. Chat later.